In January 1998, Jürgen Schrempf, the strong-willed Daimler-Benz's chairman, met with Bob Eaton, the CEO of Chrysler, at a clandestine meeting in Detroit. The reason for the meeting was a proposal, an unlikely one, which would reverberate through the business world for decades. Behind closed doors, they discussed a vision that would reshape the automotive industry. Schrempf wanted to build a global automotive powerhouse, and Chrysler was invited to be a cornerstone of this ambitious plan. This is the story of the rise and fall of Daimler-Chrysler AG, a merger that promised greatness but faced unforeseen challenges. You see, the idea of merging Daimler and Chrysler wasn't a bad one, at least on paper. Mercedes for decades had been a global luxury car behemoth that was known for quality and prestige. Chrysler, on the other hand, with 25% market share, was dominating the American markets with its gas-guzzling SUVs. With the merger, Mercedes would get a bigger foothold into the American markets, and Chrysler could go from an American giant to a global one, alongside benefiting from Mercedes' engineering excellence, quality, and innovation, and from Chrysler's lean cost structure and high-volume manufacturing. The merger was expected to yield annual cost savings of around $1.4 billion through shared R&D, streamlined procurement, and combined purchasing power. In fact, Jürgen Schrempf, Daimler's CEO, couldn't stop talking about a Welt AG, his vision of a world-spanning auto giant. Chrysler's Bob Eaton called it a marriage made in heaven. Strategically, the merger aimed to combine Mercedes' luxury and engineering prowess with Chrysler's market penetration and cost efficiency. The potential benefits included enhanced innovation through shared technology, a stronger global presence, and a more diversified product portfolio. By leveraging each other's strengths, the merged entity hoped to navigate the competitive automotive landscape more effectively and achieve long-term growth. While the intent seemed to create synergies between the two, the fine print of the deal reveals a different story, one less about shared vision and more about personal ambition and padded pockets. Chrysler shareholders got a sweet deal, stock value soared, and Bob Eaton himself walked away with a $70 million golden parachute when he retired just a year and a half later. On Daimler's side, Schrempf was polishing his own legacy. He'd orchestrated the largest ever German takeover of an American company, catapulting Daimler onto the global stage and feeding his Welt AG dream. Despite the behind-the-scenes intent, the deal was just too good on paper to turn down. And on May 7, 1998, it went through. Less than 5 months after Schrempf and Eaton's secret meeting, Daimler agreed to pay about $36 billion, making it the biggest foreign takeover in American history at that time. Most of it wasn't even cold, hard cash. It was a stock swap, which made it easier to sell to shareholders and kept both CEOs looking like geniuses in the headlines. On Wall Street, the merger was cheered as a win-win that would create the world's fifth largest car maker. Daimler's luxury engineering would finally have a foothold in America, while Chrysler would get the global reach it had always dreamed of. The celebrations were grand. Executives toasted with champagne, employees cheered in their offices, and the press conference was filled with smiles and optimism. Media coverage was extensive, with analysts praising the merger as a strategic masterstroke that would reshape the automotive industry. For a while, it really did look like a match made in heaven. The merger was celebrated as a groundbreaking union in the automotive world. Chrysler's minivans and big SUVs kept flying off lots in the US, becoming a staple in American households, and Mercedes was selling everything it could build in Europe, maintaining its reputation for luxury and performance. Daimler-Chrysler's new stock ticker, DCX, was on a roll, reflecting the market's confidence in the merger, at one point climbing to over $108 a share. Investors were thrilled seeing their faith in the merger pay off. Analysts were calling it the perfect cross-Atlantic marriage, a model for future global mergers, and the combined company boasted an eye-popping $130 billion in annual revenue, a testament to their combined strength. The two sides wasted no time chasing those synergies they'd promised, working tirelessly to integrate their operations. Purchasing departments were merged to squeeze better deals out of suppliers, leveraging their increased buying power. Chrysler's slick product development process, often called platform engineering in Detroit, was touted as something Mercedes could learn from, promising innovation and efficiency. and Daimler's engineers started poking around Auburn Hills, eager to share their expertise, sharing insights on how to build cars that wouldn't rattle apart after 50,000 miles, aiming for superior quality. At the same time, the press was loving it, covering the merger with enthusiasm and optimism. Magazine covers hailed this as the future of global car making, a beacon of industry transformation. Jürgen Schrempp was beaming like a kid with a new toy, proud of the monumental achievement, and Bob Eaton, though he'd soon step back, was taking victory laps for pulling off the biggest deal of his career, cementing his legacy in the automotive world. There was a bit of a catch to the deal. As per the details of the merger, Daimler owned 58% of the new entity, while Chrysler owned the remainder. The merger of equals turned out to be more of a marketing line than a reality. Daimler was running the show. Chrysler managers felt shut out, and that didn't sit well in Detroit. The cultures clashed. Chrysler's fast, creative style got tangled up in Daimler's endless layers of hierarchy. Projects that once took weeks to greenlight now took months. And when Chrysler's president, Tom Stahlkamp, a guy known for getting results, tried to push back, he was gone. Soon enough, the mood in Auburn Hills shifted. Chrysler folks felt like the Germans didn't respect their work, and Daimler's people saw Chrysler as sloppy and cheap. It was a slow drip of frustration, and it was only the beginning. Deadlines were missed, and the blame game began. Internal memos highlighted urgent project delays, adding to the mounting tension. The once promising merger was now showing deep cracks, threatening to split the company apart. It didn't take long for the numbers to start telling the real story. Chrysler, which had been making big money before the merger, was suddenly bleeding cash. In just the last 6 months of 2000, it lost nearly $2 billion, a gut punch that no one saw coming. Daimler, watching all this from Germany, was not impressed. They decided to take the wheel, sending in Dieter Zetsche, a trusted Daimler exec, to try and clean up the mess. He slashed jobs, cut deals with suppliers, and trimmed everything that wasn't nailed down. And then came the bombshell that made Chrysler people feel like they'd been conned all along. In a German newspaper interview, Jürgen Schrempp flat out admitted it was never meant to be a merger of equals. Chrysler wasn't an equal partner, it was a division. In Detroit, jaws dropped. The merger of equals was officially dead. Now it was Daimler's show, and Chrysler was just along for the ride. By the mid-2000s, Chrysler looked like it was stuck in quicksand, unable to escape its mounting troubles. Gas prices were climbing, and Chrysler's lineup was all about gas-guzzling trucks and SUVs, exactly what American buyers didn't want anymore. The market had shifted, but Chrysler hadn't. Meanwhile, Daimler's shareholders had lost their patience. The dream of a transatlantic powerhouse was crumbling. They were done with endless headlines about Chrysler's losses, and tired of footing the bill for a struggling American brand. The financial strain was unbearable. By 2003, some analysts were even valuing Chrysler at zero, as if the whole company wasn't worth a dime. It was a harsh reality check. So, in 2007, Daimler decided to cut their losses, literally. The decision was painful, but necessary. They struck a deal with a private equity firm called Cerberus Capital Management, hoping for a fresh start. The price? Just $7.4 billion for 80% of Chrysler, a fraction of its former value. Remember, Daimler paid $36 billion less than a decade earlier. The loss was staggering. Now they were practically paying someone to take Chrysler off their hands. It was a humbling moment for Daimler. In the end, Daimler didn't even get to walk away clean. They had to throw in $650 million to sweeten the deal and cover Chrysler's mounting debts. It was a bitter pill to swallow. Chrysler became just Chrysler LLC again, and Daimler was finally free to go back to what it knew best, building luxury cars in Germany. The merger had failed, but lessons were learned. For Chrysler, this was only the start of more drama. Bankruptcy in 2009, Fiat rescue in 2014. The road ahead was still rocky. For Daimler, it was a lesson learned the hard way. Global ambitions are one thing, but cultures, pride, and a shared vision? Those are the real engines that make a merger work. The Daimler-Chrysler saga was a testament to the complexities of merging two giants. In the end, it was a story of ambition, missteps, and the harsh realities of the business world.